Good morning. Thank you for the very generous introduction. I know how Jerry feels. Speaking of Jerry and I have been collaborating and doing these events together for what, 10 years now? And if I think back over those 10 years of working together and these sorts of events, we've been talking for 10 years about a world in transition. We've been talking for 10 years about the transition of the global economy, the transition of geopolitics. Well, I'm going to make a statement that may be thought-provoking, may be controversial. We're no longer transitioning. We have transitioned. The world has changed. Now, it would be very easy to say that it's all because of Donald Trump. I think that's only partially true. Right? The foundations, the seeds for this transition have been in place for a number of years now. But what we're starting to see today in financial markets, in the global economy, global trade, is the ramifications of that transition. And what that means is, on the positive side, there are enormous opportunities for trade, for investment, within what some people call the global south, what I would more broadly call emerging economies, trading with each other more than ever before, and I'll come back to that in a second. For too long, the world has defined the global economy and global financial markets in terms of a bipolar world. It was either the US or China. And with all due respect to the US and to China, I think that is a seriously inaccurate description, because it ignores the opportunities as well as the risks that exist in the rest of the world, in global emerging economies, global financial markets outside of the US and China. And I think if one's approach is to focus exclusively on the US and China, you're going to miss something. And that's the theme of what I want to talk to you a little bit about today. And I'll speak for roughly 20 minutes, and then I'm very happy to take your questions and your criticism in the final 20 minutes. So let me make a couple of observations. 20 years ago, the whole notion of globalization was effectively emerging economies manufacturing goods cheaply and selling cheap goods to the developed world. That business model is now largely outdated. It still exists, but it's not the real story. The real story today is that emerging economies are trading with each other more than ever before. By some measures, EM to EM trade is now up to 45% of total trade. Think about that for a second. Nearly half of global trade is emerging economies trading with each other. So when people ask me, Eric, do you believe in deglobalization? I say no. I believe in reglobalization. I believe that global trade is changing. Global trade corridors are changing. The most significant growth that we are seeing in global trade today is in the trade corridor between this part of the world and Asia. And for anybody who thinks that it's just oil, they're severely mistaken. Non-oil trade between the GCC and Asia has been growing 13 to 15% annualized for the last 5 years. I think that's one of the most profound changes in the global economy of the last 5 years, and severely underappreciated by the rest of the world, I might add. It would be naive of me and misleading for me to sit here and tell you that there's nothing wrong in the global economy today. We know what the risks are. We know that the risk of tariffs on global trade is dramatic. My team and I have estimated that at the current level of tariffs that have been proposed, and I use the word proposed diplomatically, the impact on China alone could be a decline of as much as 60 to 70% of China's exports to the United States. Now, that has implications for the US and for China, obviously, but let's talk about the implications for the rest of the world. Now, we know for a fact, and when I say we, I mean my research team, my colleagues in China, we know for a fact that Chinese exporters have been preparing for this moment since Donald Trump's first administration. So many of these companies are, quote unquote, well prepared. They've been diversifying. They knew that in the event of tariffs, they would have to redirect exports. And so the real story over the next 6 months will be what happens to those exports. Now, we've already seen a decline in China's exports to the US, and that will hit the US economic data in the next 4 to 8 weeks. But what people aren't talking about is the fact that a lot of those export orders to the US, which were canceled, have been redirected. They've been redirected to ASEAN, to other parts of Asia, to the Middle East, to Africa and Latin America. In fact, over the last 6 weeks, we've seen a decline in exports to the US of as much as 35%, but China's total export volumes are unchanged. Now, there's a caveat there. It's not all perfect, right? To move these exports, to move these excess inventories, we believe very strongly that China will have to cut prices on these goods. It's a very fancy way of saying I think China is going to export deflation to the rest of emerging economies. It's a simple problem of excess supply and not enough demand. And what I believe is going to happen is that we will see emerging economy consumers benefiting from the availability of high-quality products, but the companies in these export destinations are going to start to push back. Everybody's focused on US response to China, the European response to China. But what I would propose to all of you is we need to pay attention to the response from Thailand, from Indonesia, from Brazil, from Mexico. This is the second-order impact of this tariff dispute. The final point I'll make on global trade is that for a number of years, as I mentioned, we've been focused on this idea of a bipolar world. You're either in the US axis or in the China axis. And I think that was severely misguided. I think it was short-sighted. It ignores so many of the opportunities that we believe exist in the rest of the world. But what you're going to see over the next 5 years, I guarantee this, is sovereigns and corporate entities are going to say, I don't want the risk of being overly concentrated in my exposure to either the US or to China, so I'm going to diversify. We're going to see an increased frequency of trade agreements between sovereigns. The UK and India, classic example. And I guarantee we're going to see more of these, right? Now, for your world, that means an increasing number of what I would call bilateral trade corridors. You're going to have to start paying attention to these mini trade agreements that are going to pop up around the world. Now, that presents new opportunities, but the challenges are that it means increased regulations to pay attention to. There's not going to be a global framework necessarily for all of these trade agreements. There will be challenges in terms of the frictional cost of moving supply chains. The significant downside risk for everything that we've been watching for the last 4 months is that the frictional cost of global trade may go up. And I'm not talking about the price of goods, I'm talking about the cost of doing business. We shift gears a little bit and talk a little bit about the US specifically and a little bit about China specifically, and then what it means for this part of the world. Think of it this way. I've just told you that we're seeing a 35% decline in China's exports to the US. That hasn't showed up yet in US data, right? Because it takes 30 days for goods to arrive from China to the ports in Long Beach in California. The ports in Long Beach, California, today are still receiving goods that were shipped from China before April 2nd. So for now, everything looks fine. But there is a tipping point. There's a tipping point at which the decline in goods arrivals into the US ports means you need fewer dock workers, you need fewer truckers, truck drivers, etc., to move those goods and inventories from the ports to the middle part of the country. So you're going to see a decline in US employment. You're going to see a decline in consumer spending. And you might say, oh, but the Federal Reserve will cut interest rates. Not if inflation's going up. So if you have one conclusion from my comments today about the US specifically, it's that the risk is of stagflation. Not necessarily a recession, but a significant slowdown in US economic activity, but an increase in inflation risk. And I think the conclusion that you need to take away is that that means the central bank is not the one providing support to the economy. It'll be the government in the form of fiscal stimulus. I think the risk is a big increase in US fiscal stimulus in the second half of the year, and that means a risk of higher long-term interest rates. So that's conclusion number 2 for the US. We think there's a significant risk of a material increase in long-term financing costs across the US curve, something to be aware of. Now, it's with that concept of fiscal stimulus that I want to shift gears and talk about China for a moment. Up until today, most of the policy making in China has been focused on monetary easing, cutting interest rates, adding liquidity to the system, making liquidity more available, making credit more available. But the event that you need to watch carefully for in the second half of the year is a big increase in fiscal stimulus from China. They have the resources, they have the balance sheet, and they have the optionality. Now, the most common question I get at the moment is, whose economy is stronger, the US or China? Whose economy is more resilient to a tariff war, the US or China? At the moment, I would say the US economy is stronger. But I think China has significantly more fiscal space, which is a really fancy way of saying they have the money to spend if they want. And I think they will in the second half of the year. And so the problem in this tariff war is that both the US and China think they're playing from a position of strength. But when the US goes, or let me be more precise, when Donald Trump goes to launch fiscal stimulus in the second half of the year, they're going to have to borrow significantly to do so. And that is going to put upward pressure on long-term interest rates. Whereas in China, 10-year yields are at 1.6%. There will be demand for bond supply. Right? And so we need to start thinking about who in the world has fiscal space and who does not, because that's going to be the key driver of long-term financing costs in every economy that you all participate in. We used to spend all of our time thinking about what central banks would do. I would propose to all of you that we need to start to shift our thinking a little bit and start thinking about which governments will spend and who has the ability to borrow to fund that spending. That's going to be the driver of funding costs for the next 5 years. The second most common question that I receive is on the dollar. The topic of de-dollarization has been in discussions for a couple of years now. It's obviously picked up dramatically, considering the dollar has now declined 10% from the peak in January. And so what do we think is going on? Do we think sovereign nations are selling dollars and selling dollar assets? The data does not support it. The media loves this story. And with all due respect to the media, I hope there are no journalists in the room, so far they're wrong. So far. Doesn't mean it can't change. The data tells a different story. The data tells us that there were two groups of financial market participants that have been overweight US dollars and US dollar assets for 10 years. European investors, and the second group is both investors and corporate clients in Asia. Now, what the corporates have been doing, the exporters have been doing, they've been taking their dollar receivables and they've been holding them in dollars and buying dollar assets because it pays them more than repatriating their currency. And the investors in both Europe and Asia have been buying dollar assets because the dollar has been stronger and because dollar assets have been outperforming. It's as simple as that. But what we have seen in the last month, and to be probably more precise, the last 3 months, is the start of a reallocation, a repatriation of investor capital. We've seen a significant surge in capital into European money market funds, which is a very good indicator that people have repatriated their money home, and then they figure out what to do with it. We're seeing signs that corporate clients around the world who've been holding their dollar receivables in dollars starting to repatriate or starting to hedge back to local currency. Do I think this trend is structural? Yes. And what I mean by that is I believe that people have been overweight the dollar for 10 years because they believed there was no alternative. They were pessimistic about Europe, pessimistic about the UK after Brexit, pessimistic about emerging economies because they didn't feel they got paid enough to take that risk. And what I'm proposing to all of you today is that the narrative around alternatives has changed. Europe is contemplating an aggressive fiscal stimulus program. There's that fiscal theme again. That's encouraging a repatriation of capital back to Europe. Clients in Asia are saying, you know what, I may actually have better opportunities for my capital at home or in other markets. I don't need to be overweight US dollars. Now, I'm not going to sit here and tell you I think the dollar is going to collapse. I'm sure there are plenty of journalists who will do that. But what I do want to tell you is that you guys know better than I do that when you make these decisions about your portfolios, your balance sheets, it's never black or white. It's never one versus the other. It's at the margin. Do I want to be 30% overweight dollars? Probably not. So maybe the right answer is 20%. Maybe it's 15%. And so what I think we're going to see, and this is a huge benefit for this part of the world and for emerging economies around the world, is that people will say, okay, I'm getting paid to take that risk. There's risk everywhere. We all know that. It's how much you get paid to take that risk. And one of the other concluding comments that I wanted you to take away from today's discussion is that de-dollarization is a flawed concept because it means or it implies that people abandon the dollar. Nobody's going to abandon the dollar. The dollar makes up 47% of SWIFT transactions. Global financial derivatives are 90% underpinned by the dollar. You can't abandon the dollar. But you can change your allocation. And so I think what's happening today is a risk management exercise and an asset allocation exercise. Now, maybe the catalyst is political, or maybe the catalyst is geopolitical. But I think we need to be careful about assuming that there is a structural abandonment of the dollar. I'll just make one final comment, and then I'll turn it over to all of you for questions and, I'm sure, criticism. I don't have a crystal ball, but people do ask, how do I think this tariff conflict will resolve itself? And our baseline view within the research team is as follows. We believe very strongly that over the next 30 days, you will see the US strike a number of trade deals with countries around the world in an effort to build an alliance. Or shall I say, try and reaffirm previous alliances. And I think that will include Japan, South Korea, India, the UK, the EU, countries in the GCC. And I think what the US is trying to do is get all of its ducks in a row in preparation for a much longer and more difficult negotiation, which is with China. Now, I think tariffs from the US on China will come down significantly. But let's remember what our starting point was. I mean, we started at the beginning of the year thinking worst case scenario would be tariffs would go up to 60%. We're now double that. And what's going to happen when tariffs get brought back down to 60%? Everybody will applaud that as good news? No. That's the challenge, right? That's the risk. That's the real economic risk that we're facing, is that through these negotiations, tariffs between the US and China are brought down significantly relative to where they are today. The problem is, where we are today is a lot worse than we ever thought we would be 3 months ago. And so I think the economic distribution of outcomes, again, my attempt at sounding fancy, the distribution of outcomes is a lot wider today. Right? The risks are significantly higher. The opportunities are there. You've heard me talk about it in global trade, EM to EM. But I think it's going to be a bumpy road for the next 3 to 6 months. So look, I'll stop there. Thank you very, very much for your attention. Appreciate your time, and happy to take questions.
Thank you, Eric. We have some mics, so please, if you could help us. There are some questions. Sorry, the mic? Go ahead, over here. When asking a question, if you can just please introduce yourself briefly so that we can all get to know you. Thank you.
Thanks, Eric, for the presentation. Hamid Al-Badi, CEO of Adib. I think a lot of balls in the air, right? So we just have to see which one lands first and which one will fall. But I have a question on interest rate, right? So with all the uncertainty, and if you look at the Bloomberg screen every day, the outlook or the expectations of how the curve is moving from 4 cuts to 3 cuts to then back to 4. So what's your take on that, given all what you just explained to us? Where do you see possibly rates cuts happening this year? How frequently, and what needs to happen for even that assumption to change?
It's a great question. And look, today probably more than we've seen in a long time, it's not just the level of rates that matters, it's the shape of the curve, right? And I think for most of you in this room, that you'll appreciate the sensitivity of that comment. So look, our baseline view is that the Fed will cut rates once in the first half of the year, 25 basis points. Is that going to make a huge difference? Probably not. As I mentioned earlier, I think the risk, quote unquote, is that we see an extension of tax cuts in the US, new tax cuts, new government spending. I think Trump will try very aggressively to push that through in the second half of the year. And even though I have concerns about growth, as I mentioned earlier, I also have concerns about the fact that inflation in the United States has just not come down. It's never gone back to target, right? Even last year. And so I think we need to be a little bit careful not to assume that the Fed will cut rates aggressively this year. I think we might see 2 rate cuts, which is less than what the market is predicting at the moment. Now, I think at the moment, the US markets, the global markets are very concerned about a US slowdown, right? That's been the talk. There's a risk, in my view, that we see a temporary decline in rates, both policy rates and long-term rates, in the first half of the year. I think the second half of the year is a little bit more difficult. I think the risk is for higher long-term rates and what I would call a bear steepening of the curve. Now, I know this is a financial institutions conference, but the following comment I'll share with you I think is relevant, which is that when I talk to corporate clients about debt issuance, balance sheet risk, refinancing, that sort of thing, the comment is always the same, which is I think you get a window of opportunity in the first half of the year where rates are lower around the world because of growth fears. But as that risk of fiscal picks up in the second part of the year, I think the real risk is that rates head higher again. And don't forget, Europe is talking about fiscal. China could produce fiscal stimulus, and the US might. So if you've got three of the biggest economies in the world all producing fiscal stimulus in the second half of the year, I mean, that might help the global economy, but I guarantee it's going to push long-term interest rates higher. So it's a tale of two halves, I think, is the right way to describe it. Yeah.
Thank you, Eric, for that.
Hi, Eric. Rola Abumane, Standard Chartered Bank. Eric, the oil for dollars for oil, and while we are seeing some economies obviously are buying oil in their local currency, but this is still, in terms of quantum, very minimal. How do you see this now with the diversification, with the trade between intra-Asia, as well as with the Europe coming back on the fiscal? Do you see more local currencies, or do you still see the oil is dominant in dollar?
Thanks, Rola. It's a fantastic question, and it goes back to the heart of this discussion of diversifying exposure. I remember, I think it was probably 6 or 7 years ago, maybe even longer. Jerry, correct me if I'm wrong, but I remember when the first stories started coming out about some of the oil exporters denominating their receivables in RMB. And, I think some people mistakenly assumed that this was the start of the unwind of the dollar for oil trade. And our argument, actually I won't drag my team down with me, my argument at the time, and my argument remains, that if an oil exporter decides that all of a sudden they want to sell 5% of their oil denominated in RMB, in my opinion, that's just a diversification exercise. That's making sure that they can settle trade in different currencies. And you guys know as well as I do that when you set up new counterparties, when you have new swap agreements with a central bank, you're always testing the pipes. You're always making sure that in the event of counterparty risk, in the event of a crisis, you can continue to conduct trade in different currencies. There's an interesting analogy for gold, which I'll come back to in a second. But to finish answering Rola's question, I think you're going to see a continued move of a desire for exporters in any industry, oil, energy in general, others, to be able to settle trade in different currencies. I think that trend will continue, not just with RMB, but with other currencies as well. But let's bring it back to this part of the world. GCC currencies are pegged to the dollar. GCC economies import as much as they export. They pay for those imports with dollars. And so the risk, if they were to decide one day, I'm going to settle all of my oil sales in Indian rupee, for example, the risk for them is that they now have currency exposure. They have what we call basis risk. It means that when they go to import the goods that they need, they have to do another currency transaction. And if you speak to any central banker, I don't know if there are any in the room, but if you speak to any central banker, they will tell you they're not in the business of taking currency risk. They're in the business of managing currency risk. Now, the follow-up question that I often get is, Eric, do you think there is going to be a depeg of the currencies? No. I'll go on record just so that we're clear. Eric Robertsen is not calling for a depegging of any local currency pegs. Not now, not tomorrow, not next month, not next year. The gold analogy is really important here, because it goes to the heart of this idea of counterparty risk. If you want to buy gold, you can buy it in 3 different ways. You can buy a futures contract, you can buy an ETF that mimics the performance of gold, or you can buy physical gold. Now, 95% of the time, you'll be indifferent between those 3 ways of buying gold, right? But in times of crisis, the GFC, for example, people started to worry about the credibility, the financial credibility of the futures exchange. And so people said, I don't want to buy futures because my counterparty is an exchange that may have financial problems. And I don't want to buy an ETF because my counterparty is the creator of the ETF. So I may think I have gold exposure, but I don't. And so we saw a rush to buy physical gold and pay storage costs. The analogy to the dollar for Rola's question is interesting, because what it means is that people are going to start thinking very seriously about who their counterparty is in every transaction. And if you don't trust the counterparty, then you're not sure if the financial exposure that you have remains valid in those 5% times of crisis. So I think, Rola, that's what people are doing. People are stress testing their pipes. They're trying to make sure they can settle all of their transactions in a variety of currencies to make sure they can maintain the exposure they need to make.
One last question. BRICS. What's your views on BRICS and the future of BRICS now, the current situation?
The current what?
Situation of the BRICS.
Of the BRICS.
Yeah.
So again, I'm at odds with the media on this one. The media doesn't like me very much. BRICS as a construct, as a creation by Jim O'Neill, is an economic construct based on trade, based on economic dynamism, based on growth opportunities due to the demographics, the growth of the local population, the growth of the middle class. Originally Brazil, Russia, India, China. The grouping known as BRICS has obviously expanded. That's good news, right? Getting more economies, this grouping that I talked about earlier, the global south, EM to EM, getting these economies together to talk about free trade agreements, to talk about a variety of factors, is immensely valuable. Do I think we're going to see a BRICS currency? No. And I say that because in a world that is increasingly multipolar, sovereigns and central banks will want flexibility. They'll want monetary flexibility. In most cases, they'll want currency flexibility. Very few sovereigns, in my opinion, are going to give up the flexibility of their currency to join a currency unit that is going to be underpinned by a variety of economies of varying degrees of financial strength. Now, we can sit here in the UAE, or we can sit here in India, we can sit here in Brazil and talk about the strength of the domestic economy, the strength of the financial system, the strength of the currency, and say there's no way I'm going to sign up for a currency basket where I'm sharing monetary flexibility with a number of currencies that are simply much lower value. So, an important economic construct, a very important trade construct, but I struggle to see a currency unit.
Thank you, Rick. I think we can take one more question. I believe the gentleman in the back had a question, or? Okay, so there are 3 questions. Let's see if we could address
Squeeze them in.
very briefly.
Yes, my name is Haytham. I'm from Al-Aziz Islamic Bank, over here.
Thank you.
So just a question regarding the fiscal stimulus that you have mentioned, and how you can see it in relation to the sovereign debts, the current level of sovereign debts that are at the current level that we are having now. And you mentioned that the allocation of assets, but that for me is still transitioning, and it's not that we have already transitioned. That's it.
Sure. Look, there's a positive angle and there's a more cautionary angle. The positive angle is that I think economies and governments and policymakers around the world are recognizing that monetary policy alone doesn't solve an economy's challenges, right? It's difficult to direct. It doesn't always go to the sectors that you want it to go to. Fiscal stimulus is a much more precise policy tool. But in the instances which you refer to, which is economies or countries which may not have the financial resources to deploy that fiscal stimulus, they're dependent on borrowing. And what has happened in the last few years is that we've seen the capital markets become increasingly bifurcated. And what I mean by that is if you're a high-quality issuer, you can get as much capital as you want. For the issuers which have a ratings challenge, or in some cases no ratings, the cost of financing is prohibitive, right? It's prohibitive, right? Prevents you from accessing the capital that you need to fund fiscal stimulus. And the risk, and this is the cautionary tale, is that if every country around the world starts to pursue fiscal stimulus and increases their borrowing to do so, it's going to drive global long-term interest rates higher, which makes financing costs for that stimulus higher. And that's the negative feedback loop that we are at risk of going into. And so I think that's the cautionary tale, right? And it's why I've been saying to people, if you have borrowing that you need to do it earlier in the year rather than later, right? Because we run the risk of what they call crowding out, right? The first 2 or 3, no problem. 5 or 6, no problem. Then you start getting the 10th or the 15th issuer trying to tap the markets. Investor demand is already satiated, and the cost of that borrowing goes up. So this is the risk on the fiscal side, is that everybody rushes to the market at the same time to start borrowing for their fiscal stimulus plans, and they realize they can't afford it.
Thank you, Eric. Shiko?
I think quick question, Shiko from Al Bilad Capital. You talked about dollar and the impact and the evolution as you see it. How do you translate that in capital markets activity, primarily focusing on fixed income and sukuk issuance? Do you see an evolution of non-dollar denominated issuances, especially a trend of euro bonds which have been there and matured? Do you see any shift in that trend? And how would you see evolution on the fixed income side?
Sure. Look, the first point I would make is that as both investors and issuers start to diversify out of dollars, as you alluded to correctly, the first stage, the first step of that is to other what are perceived as safe haven currencies, right? You're going to see more issuance in euro. You might start to see more issuance in yen. We've started to see more issuance in RMB, for example. To go into what I would call true local currency debt market regimes, there's 2 things that you need. You need the broad dollar to be weaker, which has started, right? That's hugely advantageous for local currency debt and capital markets. But the second thing you need is the belief that the sovereign or the corporate balance sheets of those issuers are sufficiently resilient to currency risk, right? And look, I'll be very candid with you. One of the mistakes that I made in the last 18 months is I argued that the growth premium in Asia and the attractiveness of currency levels was sufficient that we would see a return of global capital back to Asia, which would present enormous issuance opportunities for those markets. Now, I think the economic view was correct, but the capital markets view was not, didn't play out that way. I'd make one quick observation. Again, I think this will be interesting for all of you. The weakness of the dollar provides flexibility for global central banks that they have not had for 10 years. And what I mean by that is if the currencies around the world are all starting to strengthen against the dollar, the risk of imported inflation goes down. And that means that central banks around the world can start easing monetary policy. I'm not talking about the US, but I'm talking about everybody else. And we've seen it already. Thailand has cut rates. We expect Korea to cut rates. India, I think, will be able to keep cutting rates, right? We're seeing this around the world in emerging economies, this newfound flexibility for central banks to be able to cut rates, and that will help. That will help significantly with this capital markets deepening that I think you're driving at, which is critical.
Thank you, Eric. We have time for one last question, so please.
Thank you, Eric. Sabri from Vakıf Participation Bank, Turkey. As you may know, global Islamic finance built upon US dollar and peg currencies. So you talked about the reallocation of the assets. From strategic perspective, how do you see the impact on the global Islamic finance market shifting from US dollar to some emerging market? Obviously, there are certain regulations, currency risk.
Look, I'd make the following point. On a positive side, even if we see a diversification from the dollar, I still think people will want hard currency exposure, right? Which is financial market lingo for not being in local currency exposure, right? And as long as you believe that there are hard currency alternatives to the dollar, then I don't think that that's a problem, right? I take your point, though, on the interest rate side, right? I mean, we have lived in a world for 20, and some would argue 40 years, of either declining or stable dollar interest rates. We've lived in a world where what we call the risk premia for US interest rates has been low. That has allowed the financing markets in all of the other connected spots, Islamic finance is just one example, to grow and to flourish, right? The risk that I think we really have to pay attention to is a significant steepening of the US yield curve, driven by an increase in risk premia, right? Because if people start to lose confidence in the US Treasury market, then I would say that we've all got bigger problems, right? And it's not my forecast, right? I'm not suggesting that the US Treasury market becomes destabilized. I think risks are that it's going higher in yield, but that's very different from an unstable environment. It's still the most liquid market in the world. The European market is disjointed, right? That's not me being critical, that's just a statement of fact. The European fixed income market is disjointed. It's the biggest mistake in the EU project, in my opinion. So as long as the US Treasury market and the US rates market remains the dominant foundational yield curve, and as long as people feel like they have alternative hard currencies to work with, I think the opportunities are very, very good. But you know as well as I do that in periods of risk aversion, people go in the risk frontier, not out. So, thank you.
Thank you very much, Eric. Thank you all for an engaging Q&A
Thank you very much,
session.
everyone.